Greetings, my name is Kevin Matthews and I am the tax professor. I want to welcome you back to the Tax Academy, where class is always in session because the learning never stops. We're going to talk today about reporting interest on U.S. savings bonds. I'll tell you a quick story. So when I was a kid growing up, I still remember for my birthday periodically I had an aunt who used to send savings bonds over. And I remember looking at it, and to me, I mean, I remember when I got my first one that I remember, I was probably around 5, maybe 6 years old. And to me, it looked like funny money. I mean, usually when mommy pulls out a $10 bill, it's, kind of papery, it's, does all that stuff. These savings bonds look like they're cardboard. I don't get why, and so for me, it just looked a little different. They kind of look cool. Now that I'm getting a little bit older, I'm not so sure that I see them as a very good investment vehicle. I mean, you don't see as much popularity in buying savings bonds as you did in the past. There's still some cases where this still makes sense. Obviously, I'm not a financial investor. I'm not telling you whether you should be buying bonds or not. They don't work for me, but that doesn't mean that it won't work for you. Make sure you're talking to a financial advisor before you do that. One of the things that you need to understand about savings bonds, you can actually do, so say for example you go in and you buy a savings bond. Actually let's back up. You have $10,000 and you decide, I have two places that I can put this. I can put it into a bank, or I can go buy a savings bond. From a tax perspective, what's the difference? So if I take $10,000 and I put it into a savings account, I'm going to collect interest on that savings account every single year, and I'm going to pay taxes on it every single year. And the reason why is because the bank's going to pay you interest. You have access to that money immediately. You can do whatever you want with that money now after the bank's paid you the interest. As a result of which, you are going to pay taxes on that. There's just no way you're going to get around that. Savings bonds are a little different. There's actually an interest deferral on Series E bonds that basically, if it's dated May 2005 and after, and a fixed rate of interest, bonds, what ends up happening is that there's a fixed rate of interest for bonds that are after 2005. Bonds purchased between May of 1997 and April 30th of 2005 earn a variable market rate of return. All right. So what's going to end up happening is those are the types of interest that you're going to have. However, there's going to be a deferral on those as you have. So, and what do you mean by a deferral? In other words, the IRS is not going to be able to tax you on the interest that you're earning on the bond until the bond's cashed out. Okay, and the reason for that is, theoretically, I can't go to my savings bond and say, yeah, I've earned a little bit of interest here. Why don't you send me a check for that interest that I've earned, and I'm going to go ahead and I'm going to use it whatever I need to use it for. It doesn't work that way. You want to get access to the interest, you got to cash the bond. Okay, so basically what ends up happening is that there's a deferral that ends up doing that. Series E bonds are sold at half their face value, and this is like when I was a kid. I remember I used to get $50 savings bonds. Basically, my aunt went out and spent $25 on each one of these bonds and then sent them off to my mom for safekeeping. It isn't worth its face value until it's matured. The electronic Series E bonds are sold at face value and are worth their full value when available for redemption. Okay, the minimum term for ownership is a year, but penalty is imposed if the bond is redeemed in the first 5 years. The bond earns interest for 30 years. So if you have one of those savings bonds and it's getting close to that 30 years, you might want to go ahead and cash it, because after 30 years, it ain't going to earn anything anymore. Okay, like we said, they don't pay interest currently, which is why they don't get to tax it. You get paid on the interest when you do the cashing in. Interest is not taxed as it accrues unless the owner elects to have it taxed annually. I don't know why you would do that. My personal opinion is I would do it when it's cashed. And there's a major reason why you want to do it that way, in my opinion. Obviously, talk to your CPA and make sure your circumstances fit the general issue that I'm going to have here. I would not elect it, and here's part of the reason why. You don't know what you're going to use that money for. There's actually a thing that if you use if the bond's owned by the children, I'm sorry, let me step back here. So you don't know what the bonds are going to be used for. So say, for example, you decide that you're going to go ahead and you're going to use this and you're going to pay for education. That interest is not taxed if it's used for education expenses. Okay, so there's definitely a thing that you want to take into consideration. Are we going to use this in order to pay for educational expenses? And if that does end up happening, and you've made the election to take all the taxes on it as it is, you don't get to go back and say, mea culpa. It doesn't work that way. Okay, so you want to make sure that you are setting it up correctly. And I say, unless you have like no kids, or you have nobody that you couldn't even think that you're going to want to give these things to, maybe you want to do it if the tax situation is. But I can't. It would be difficult for me to even see that. So I would go ahead and make sure that we get that set up correctly. Okay. There's also indexed series bonds, I. They're designed to offer a rate and return over and above inflation. Now, one of the biggest things that we have with a lot of these bonds and with a lot of interest-bearing accounts is that sometimes they don't keep up with inflation. They have these things, and they're called TIPS, which is Treasury Inflation Protected Securities. So basically, what it is that they say, look, we're gonna pay you whatever interest plus a premium on top of that, in order so that you're not losing the dollar value as part of your interest rate. Obviously, the interest rate is less than on the other types of savings bonds, simply because of the fact that you are getting that protection. Now, one of the things I do want to talk a little bit about, and my notes kind of go into this, but it's not really that deep. If you have federal interest on federal bonds, and that's not just savings bonds, but they could also be, treasuries and things of that nature, and different types of vehicles that you can get. The interest that you receive off of that is not to be taxed at the state level. Okay, so, and there's actually court cases that prevent them from doing this. Okay, so they should not be doing that. So if I earn bond interest, it's going to be, and I live here in the state of Virginia. Virginia doesn't get to tax that. Okay, you have to, in order for Virginia to be able to tax it, it has to be a non-U.S. Treasury based, and it's part of that whole separation of government. I could go into the cases about it. I won't. It's just the way that it kind of works out. At the same time, state, municipal bonds are generally not taxed at the federal level either. If so for example, if there's a school building provision that they're going to do here, they're talking about putting bonds out for it, and I say, hey, I'll go buy bonds to support my local school district, but at the same time, I also want to do an investment that can add, something to my portfolio, so that it actually works out better. What ends up happening is then you then can receive a tax benefit of, at the state level, you may pay taxes. We'll get into that in a second. At the federal level, you definitely won't be. Generally, if you are buying municipal bonds within the same state, the state will also not tax you on that, provided that is for the reasons that they've outlined. So if for example, if I buy highway bonds here in the state of Virginia, Virginia won't tax me. Federal government will tax me. So it's actually a really good deal tax-wise. Now, financially, is that a good deal? Talk to your financial provider about that. And I think that it's going to work out. So anyways, that's all I got to say about that. I know it sounded a little wonky in the beginning. Again, my name is Kevin Matthews. I am the tax professor. I want to thank you for coming to the Tax Academy, where class is always in session, because the learning never stops. It's not going to stop till we're dead, folks. So, you got to keep learning, keep learning, keep learning. You want to keep that learning. One way that you can do that is you can go on the comment box below and you can opine, or you can ask questions about anything that we've got in here. If you want to ask me for a more intimate one-on-one conversation, you reach out to my website at www.betasolutioncpa.com. Again, that's www.betasolutioncpa.com. And I'll be happy to reach out to you. Again, if you like these videos, please hit the like button. We'd really appreciate it. And then if you like the series, please go ahead and hit subscribe, and then we'll give you updates as to when these are going to come out. Okay, thank you very much for watching.